Hello traders, Gary Wagner here, just about 9:45 in Honolulu, 3:45 in New York on Thursday, March 17th, 2016, and this is the Daily Report for Gold and Silver. We do have the precious metals under some pressure today. Gold is trading lower, off about $5-6 on the day. It is traded to a high of 1270.94, so call that 1271. Interesting number. We'll talk about that when we pull out our first chart. Low today has been 1254.62, and we're sitting at 1255 and change. So as you can see, we are under pressure, and we are trading near the lows of the day. Now, interestingly enough, when we take a look at markets that would affect gold, most importantly the dollar, you can see that the dollar is under tremendous pressure. It is off over a full percent, and that's at 94.80. Now, the interesting thing about that is when we look at the dollar index and compare that to how that's affecting gold. In fact, let's go ahead and get a Kitco gold index chart up so we can look at that exact set of numbers. So as I said, to really get an actual idea of what we're looking at in terms of market scenario, we are trading off about $5-6 on the day, currently off about $6.30. But as you can see from the Kitco Gold Index, that doesn't tell the full story, because right now normal trading is creating a lot of selling in the market, actually taking gold down about $18.40, 1.5% lower. However, when you add into the fact that we've got a devastated US dollar today, down, as I said, 1.14%, that gives it about $12 in value, and that's where we're getting this net gain of 640. Let's go ahead and take a look at our first chart. So traders, the first chart that I do want to visit today, I should say revisit, because this was the chart we used for the bulk of yesterday's show, and that was looking at the sub count, the most minor of counts, and our calculation as this market went up, that it was my belief that we could in fact find some sort of a ceiling at about 1272. Now, that was simply based upon the fact that we were under this current model in which we are looking at our wave count 1, 2, 3, wave 4, wave 5. That completes a minor first. Okay, a minor 1, and now we're into our subcount, I should say, subcount 2. Subcount 2 should probably be composed of some sort of an ABC, although there are a multitude of different types of corrections. But what we talked about yesterday was the fact that typically, and I called this our sweet spot, but typically you will get this market tracking anywhere between 50 and 75% of the move that we saw in A, and that's exactly what these numbers are calculating, from 1257 to 1272. Now, the fact that we had a high that came in roughly at 1271.90, that's as close to 1272 as you're going to get. I think that we've effectively hit that top and could now in fact complete this ABC pattern to have maybe one more leg down, and depending on how this market trades, in other words, we would get an ABC if we get a lower low here and it just basically goes down. Another plausible scenario, because realize we've completed one and we're now in two, it could be some sort of a compression move in the market or some sort of a triangle. We would know that if we make a higher low as this market comes down. In other words, if it comes down but doesn't quite trade to these lows at, call it 1226, then we might be looking at a range that is consolidating with a series of higher lows and lower highs until we reach the apex, and then we would break. In the case of where we're looking for this market to break on a compression triangle, of course, we would be looking for it to move to the upside. And the only other concern that I have right now is the fact that these waves came very, very quick. This A is a very, very quick spiked but we are looking at a sub count, but typically that sub count will take anywhere between 4 days and a week to kind of unfold. So we'll really have to see what this market wants to do. But as I said yesterday, I was hesitant after we saw the major $30 spike come immediately following the announcement by the Fed. I felt that to jump in on the long side, well, that was not to be in terms of timing. I just didn't feel comfortable with it. I also wanted to see if the market would kind of cap itself at 72, and if that's the case, which that is what we see unfolding, I do believe we could see a little bit more downside, but traders realize overall I'm extremely bullish on the market, but even a bull market is going to be comprised of peaks and valleys. And so traders, finally, I do want to take a look at the more long-term Elliott wave count as we did yesterday. But the other thing that I want to do is I have the longer Elliott wave count here and what we can address just so I can make sure that it is a pretty clear move to our subscribers. When we look at how this market came down and then it hit, this is our sub count 5, intermediate in red, of course, I'll blow it up in a second, and then our major A, that completed this downward pattern. Now, all of this most recent rally that you see from these lows at about 45 up to these tops here at about 1287, all of that is part and parcel of this entire move right here. In other words, what we're calling as a sub count of 1 can be then broken up into its 5 count. And in this case, the 5 count is here, 1, 2, 3, 4, and then 5. And that's all composed right here in 1. This little dip that you're seeing now, and realize this is a weekly chart, this is really going into some sort of a wave 2 down, and that I believe will be followed by a wave 3 up. And as I said yesterday, the most exciting thing about the conclusion of this 2 down, the corrective wave down, is that we should in fact see gold easily break through $1,300 per ounce once we get back into the swing of things, go back into rally mode, and begin this wave 3. Now, once again, this wave 3, 2, and 1, these are all part and parcel of a sub count behind our intermediate count, which will go 1 through 5, and that will be our first wave on an intermediate count. And that's why when I talk about this B wave as being a multi-year move, I think you can start to see how that pans out, because realize when we look at this weekly chart, and this has got, of course, our major 5th conclusion of our A wave, and as you can see, the intermediate count, and again, this is weekly, can stretch. This starts roughly at 2012, and it culminates about 10 months later. Each intermediate wave count can be as long as 10 months to a year. And that's why I believe it's a multi-year move that we're looking at. However, the most exciting thing that we can derive out of this is if in fact that's what we're going to see unfold, we are in for higher gold prices, higher precious metals prices across the board over the next couple of years. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.